All right, our next guest runs more than 150 hedge funds with more than $6.5 billion in assets, or at least he works with them. Jack McDonald is the president and CEO of Conifer Securities. He says money is starting to come back into hedge funds, and fundraising has gone from impossible to just very hard. Jack, thanks very much for joining us.
Thank you.
Execute trades and help administrate these hedge funds. I'm assuming you don't run all 150 of them.
I don't run any of them, but you're right. That's what we do.
But you work obviously very closely with them, and you say that it's just very hard now to raise money. I mean, what does it look like? Which kind of funds are getting the money, I wonder? Because we did a story a couple weeks ago saying the big ones are getting it, the little ones are having a lot more trouble.
And that's certainly true. 2009 was a good year in terms of hedge fund returns, and I think hedge funds did what they were supposed to do. They outperformed both the broader markets and the long-only managers. We did start to see money coming back into the industry in the end of 2009 and certainly this year. But the bulk of the money is going to the more established managers. It's the 80-20 rule and then some. That said, we are starting to see more hedge fund startups. The number of startup managers is outpacing the number of closures, so that's healthy for the industry. And in terms of allocations, what we're seeing is money going back into long-short equity strategies. So the fundamental long-short equity guys, converts are picking up steam, event-driven, and some of the distressed strategies are doing well at the expense of specifically some of the emerging market managers or long bias managers.
But Jack, we're nowhere near where we were pre-crisis levels in terms of hedge funds.
That's right. Well, the numbers are down. I think the assets in the industry, it's a little tough to peg, but at around 1.6 trillion versus 1.9. So we're getting back there, and certainly well up from the crisis level. We're not quite back to pre-crisis, but assets are up in the industry year to date. And as I said earlier, I think it's gone from an impossible fundraising environment to a very difficult, but we are starting to see some money flows.
It's interesting, emerging markets hedge funds are taking a hit here because it would seem that people chasing yield, not finding it in debt here in the U.S. or the equity market here would go after that kind of strategy.
Well, I think it's just very difficult to predict, right? It's a very difficult world economy right now, and there's lots of uncertainty. And so global macro themes and emerging market themes are having a tough time. I think it's difficult for everybody. It's a sideways kind of market, and I think many managers do better when there's a direction that they can either bet for or against. So it's difficult across the board, and you see that, frankly, in a lot of the returns that are out there in the industry.
So, Jack, a lot has gone on with the industry in the last couple of years. I mean, in terms of what you're seeing, what changes are happening that you think are going to stick going forward here, longer term?
I think the investors have really stood up and been heard over the last year and a half, and we're starting to see that in terms of the structure of funds. There's a term of art floating around the industry now, alignment of interest, and how hedge fund manager fees are being negotiated. We have advanced terms in terms of liquidity and transparency that investors are now demanding, and that's being shown, and we see a window in this into our world, the way we support separately managed account platforms. It's a different vehicle for managers or single manager funds. We're also seeing a lot more focus being put on how hedge fund managers or money managers set up the infrastructure, how they have a middle and back office is going to withstand investor scrutiny. Very important part of the process now, where performance used to rule the day. There's a lot of other questions being asked.
I wonder about, we did a story the other day on somebody who was cutting prices or at least changing the pricing structure and going to 2 and 30 instead of 2 and 20 plus some other fees. I mean, that still seems fairly expensive to me. Are they getting cheaper?
There's not as much fee compression as you might think. We're starting to see a little bit more on the management fee side of the equation. The performance fee element, the 20%, I think most investors are happy to pay for when they get outsized performance. But where we are starting to see it is more on the management fee side. Again, there are other aspects of the fee structure, not so much the 20% performance element to it, but how it's structured, when that payment gets paid out, and what other sort of, again, alignment interests that get packaged together in terms of the relationship between investors and their manager.
Hey, Jack, something I want to ask you about that's certainly been in the news over the last few weeks, where you've got Wall Street firms shutting down or closing down or moving around their prop trading desks. How will that impact the hedge fund industry? Obviously, less competition.
Well, that's certainly one of the consensus views, that there's going to be less competition out there and that it's going to be a net positive for the hedge fund the typical hedge fund returns and performance. That's a hard argument to refute. Candidly, time will tell. The other thing that people were talking about 6 months ago is that you would see a real resurgence of startup managers where a lot of folks would leave the big investment banks, prop trading desks, and go and start their own funds. And we certainly are seeing some of that. Some of the higher profile prop desks are spawning out startup managers. And we're also seeing teams sticking together and are going to some of the more institutional, larger money managers who don't run an investment banking process but are willing to take a bet on a whole team and bringing them over. So I think you'll see more managers that's going to be on the private side. And again, this performance boost, most people think is going to become a truism.
You know, Jack, kind of to sum it up, I was talking to some SEC guys the other day who were saying that the idea of Dodd-Frank is to try and spin off risk from banks into the hedge fund sector. Do you think that's coming true?
I don't think that's coming true. I don't think hedge funds were the root of the problem over the last couple of years. It's certainly there's no evidence to suggest that, and I don't think you're going to transfer risk from one grouping of managers or entities to another. I think it speaks to overall market governance and the way things will be structured going forward. Whether the bark will be worse than the bite, it still has itself to play out, and we'll see. It's going to be very interesting next 6 months in the asset management industry.
All right. Hey, Jack, thanks so much for joining us. Jack McDonald there. He executes trades and helps administrate hedge funds for Conifer Securities.
All right.